Wi-Fi video series 78. We had completed our discussion on non-current assets of a balance sheet. Now, while this video series 79, we shall start our discussion on current assets. In simple terms, current asset is defined as an asset which can be converted into cash within a period of 12 months. And such assets are also a part of the operating cycle. That means to classify an item as a current asset, there are two conditions need to be satisfied. One, it should be convertible into cash in the next 12 months maximum. It should also be a part of the operating cycle. The current assets are divided into one, current investments, inventories, trade receivables, cash and cash equivalent, short-term loans and advances, and other current assets. This is how the current assets appear in the balance sheet. The format is depicted here. Schedule 3 of the Companies Act 2013 says that an asset shall be classified as current when it satisfies any of the following criteria. 1. It is expected to be realized in or is intended for sale or consumption in the company's normal operating cycle. That is, it is either intended for sale or it is otherwise for consumption. Consumption, when we say, is that raw material consumed and it becomes a finished goods in the normal operating cycle. Second is, it is held primarily for the purpose of being traded. It could be a short-term investment. The very purpose is to trade it. The third one is, it is expected to be realized within 12 months after the reporting date. That is, if a balance sheet is drawn as on 31/3/2020, the current asset should be realized within 12 months from 31/3/2020. The last one, it is a cash or cash equivalent. If any one of these conditions are satisfied, such assets can be classified as current assets. Now, they are supposed to be realized in one operating cycle. That is one condition was stipulated. And we know the operating cycle is a time between the acquisition of assets for processing and their realization in cash or cash equivalent. We have already discussed the operating cycle of a service provider, a trader, and that of a manufacturer in my earlier video series 77 part 4. Please refer to my previous video for details. Now the next one is current investment. Any investment which is held primarily for the purpose of being traded. Investment in equity instruments like shares, investment in preference shares, investment in government securities, investment in debentures or bonds, investment in mutual funds, investment in other partnership firms, or any other investment. If the investment is made with an intention to convert that into cash in the next 12 months. Such investments are called current investment, and such current investments are part of a current assets. Under each classification of investment, as per the Schedule 3 of the Companies Act, details shall be given of names of the bodies corporate, indicating separately whether such bodies are subsidiaries, associates, joint ventures, controlled special purpose entities. And further, under each classification of investment, the following also shall be indicated: the basis of valuation of individual investments, aggregate amount of quoted investment and the market value thereof, aggregate amount of unquoted investments, aggregate provision made for diminution in value of investment. These are the additions in the Companies Act 2013. That is, more data is required with respect to the current investments. Now we will go to the next item after having done the current investment: inventories. Inventories is nothing but stock of goods. The inventory shall be classified as raw material, work in progress, finished goods, stock in trade. That is, the goods which are acquired for the purpose of trading. Stores and spares, loose tools, others. These inventories is in respect of a manufacturing concern. If it is in respect of a trading company, there will not be raw material work in progress. It will be only straight away finished goods. Now the goods in transit, if any, shall be disclosed under the relevant subhead of inventories. That is, I have already placed the order and the goods is coming and I have made the payment, or the payment is yet to be made. The goods are coming from the supplier's place. In such cases, it shall be separately shown as goods in transit. And mode of valuation shall be stated. Whether the mode of valuation is the market price or the purchase price, whichever is low, or is it a last in first out, or is first in first out. What is the type of valuation that is done on inventories need to be mentioned. The next item is trade receivable. A trade receivable is an account payable. It is the money one company owes another for goods or services received but not yet paid. Trade receivable means the company is selling some products to some buyers and the buyers have been given some time to make payment. Pending receipt of payment, they are known as trade receivables. Now, aggregate amount of trade receivables outstanding for a period not exceeding 6 months. Aggregate amount of trade receivable outstanding for a period exceeding 6 months from the date they are due for payment. It should be segregated. That is, whatever may be the balance outstanding of the trade receivables, they will be segregated between one which exceeds 6 months, which is well within the 6 months. And again, the segregation of the trade debt has to be done as secured considered good, unsecured considered good, and doubtful. And the trade debts, if any, due from either directors or any officers of the company, or any of them, either severally or jointly with any other person, or the amount due by firms or private companies where the director is a partner or director, should be separately mentioned. So the trade debt, the additional data which are supposed to be incorporated as per the Companies Act, give lot of vital information to the lenders. The next one is cash and cash equivalent. One, balance with the banks, checks draft on hand which are yet to be deposited to the bank, cash on hand, any others. Any earmarked balance with the bank, for example, for paying dividend, should be separately mentioned. That is, that cash is not available for business. Next one, in case any balances of the bank to the extent held as a margin or security against the borrowings or against the guarantees or letter of credit issued shall be separately mentioned. And bank deposit with more than 12 months maturity shall also be disclosed separately. Now the short-term loans and advances which the company gives to somebody. One, it should be segregated as to related parties, to others. Related parties means to the director, the promoters, or the group company, or associate, or joint associates, or group company, etc. They should also be segregated as secured considered good, unsecured considered good, and doubtful. And any short-term loans due by either directors or any other officers of the company, or any of the directors or other officers jointly and severally with any other person, or amounts due by firms or private companies where the director is a partner or a director is a director should be separately mentioned. Other current assets are any item which is not included or doesn't fit into any other places shall be included here. With this, we have completed the current asset part of a balance sheet. Now let us do a quick summary of items of balance sheet as per the Companies Act. First, there is a balance sheet is divided into liability and assets. The liability is further divided into shareholders fund, non-current liability and current liability, whereas assets are divided into non-current assets and current assets. And equity or the shareholders fund is divided into share capital, reserves and surplus, money received against share warrants. Or share capital is again divided into equity shares or ordinary shares, preference shares, and again shareholders fund, one more thing is added, share application money pending allotment. And non-current liabilities are further divided into long-term borrowing, deferred tax liabilities, other long-term liabilities, long-term provisions. And long-term borrowings are divided into bonds and debentures, term loans from bank and others, deposits, loans and advances from related parties. And current liabilities are divided into short-term borrowing, trade payables, other current liabilities, short-term provisions. And assets are divided into non-current assets and current assets. And non-current assets are further divided into fixed assets, non-current investment, deferred tax asset, long-term loans and advances, other non-current assets. And fixed assets are further divided into tangible fixed assets, intangible fixed assets, capital work in progress, intangible assets under development. And current assets are divided into current investment, inventories, trade receivables, cash and cash equivalent, short-term loans and advances, other current assets. With this, we have completed the balance sheet, the liabilities and the asset part of it. In my next video series 80, we shall continue our discussion on the next financial statement called profit and loss account statement and understand the new format introduced and also the various items therein. Subscribe to this channel to receive intimation on new videos. Press the like button and share the information with your friends. Thank you very, very much.